Okay, let us make a slow beginning again. We rejoin. So here I just wanted to capture the different perspectives of people who mattered in the financial markets. That's why. Because already I told you about the rise and fall of long-term capital management, how even Nobel laureates, they had to fold up before the market, and their war model also had some outlier events which were not captured. Like that is also another perspective. Now, here I did mention about the unbundling of the risks and transferring it to those who are willing to assume them, like that Alan Greenspan has said. Now, how this unbundling happens, we will try and understand through an example. Example is something that happens in the ordinary life. Now, how risks are unbundled and how they are transferred. So now we are trying to look at futures contracts. I am trying to bring to you a concept, what is the need for a future when there is a forward contract already. That is the point I am trying to bring out. Okay. So here, the first difference between a forward contract and a futures is forward contract is over the counter. It's between two parties. Either it can be a bank and the customer or between two banks. But straight away, you can go and ask for your requirement date. Can be 1st December, can be 10th December, 15th December, exactly. Your requirement amount can be for 1 million, can be for $500,000, can be for $600,000, $225, like that, customized. Whereas futures means always it is traded on the exchange. So for standard lot sizes, standard lot size for currency futures is one contract is equal to $1,000. So here, if you want to trade in currency future, you will be trading on a lot of $1,000. So that is what you should understand, standard sizes and standard maturities. Last Thursday of every month, the futures contract expire. Similarly, this is exchange traded. Other one is over the counter, OTC. This is ETC, exchange traded contracts. Exchange traded means earlier forward contract December 24th, Bank of Baroda may give 78.50, Canara Bank may give 82.50, Canara Bank may give 82.51, SBI may give 82.49. Like that, there could be small differences in the counterparty's quote. Whereas exchange traded, order driven, anonymous, everybody at this point of time can see 82.50. Then next time it can move to 80. Like that, but at some point of time, everybody will have access to the transparent screen. So it is anonymous and screen-based, exchange traded. And therefore, the settlement mechanism also is on the exchange. We will analyze that a little later. So there is a settlement risk is also avoided. Whereas here, if the bill is not given on the due date, the bank which has given the forward contract runs an exchange risk on the, runs a settlement risk on the customer. So customer has not given the dollar, but KARUR VYSYA Bank has already committed to give the dollar to Canara Bank. So in order to cover that, they will have to go to the market and buy. So like this settlement risk or counterparty risk is there in an OTC contract like forwards, whereas on an exchange traded contract like futures, the counterparty settlement risk is not there. So this is about the features. Now we will go into that. Now, assuming you are building a house, and in 3 months from now, you will need 1,000 bags of cement for structure and roofing work. So now, cement prices have been firming up during the last 3 months from 180 to 200 per bag. That is all general market information. Now, you are in a dilemma. Fix a certainty whether you should drop the price of cement or you should buy it on the daily requirement from the market. Now, what is your loan rate? Easy for you to understand that 1 rupee is the interest cost on 100 rupees. per month. So that is why I put the interest rate at 12%. Okay. Now the cement dealer offers to supply cement 3 months from now at 200 per bag, irrespective of future price movement, if payment made today. This happens locally. Like today itself, you pay the price, sir. मैं आपको cement दे दूंगा. Like your gold also, sometimes it happens, some of the jewelers, but gold more in the form of an option. Here, the dealer is committing to give you cement at 200 irrespective of the price, because 180 means still you end up paying 200, 220 means still you end up paying 200, but you pay 200 now itself. That is what is the customer asking. And sometimes these, what is it, over the counter, no? one over the counter, you can strike deals with your cement supplier like this. So this is a example of a futures contract. That's what I'm trying to, but I'll explain it. So the funding cost, 200 rupees if you were to pay from your housing loan disbursement for 3 months, that 200 will carry an interest rate of 1 rupee per 100 per month. So for 3 months, 3 rupees for 100, and for 200 rupees, 6 rupees. So your cost is essentially 206. Cost means a purchasing cost will be 200 plus 6 rupees, your funding cost. This is called the what is the locked-in price of the cement for 3 months from now at 206. Now, you also know from the background that the price has moved from 180 to 200 in the recent past. So this is what is your dilemma, whether to take a decision or not, and strike the deal or not. Now, supposing you strike the deal. Now we are looking into the arithmetics. You have locked into the future price of cement 3 months forward from today at 200. So your funded cost is 206. I have already explained that. So you are prepared to bear that 6 rupees extra, so that even if price goes to 220, 230, 240, you are assured of cement at 200 plus 6 rupees funding cost, 206. But a fall below 200, you have no recourse, because that is the deal that the supplier has given you. Today you pay 200. Whatever is the price, I will give you cement at 200. So this is like a forward contract. The upside you lose, downside you are protected, just like the forward contract. Now, 3 months later, there can be a possibility that the dealer is not to be seen at all. He has folded shop and gone. This is a over-the-counter contract, a credit risk on the counterparty. Okay, credit risk. So how do you protect yourself? That you sign an agreement, or you can do a credit derivative. This is where the derivative assumes importance in terms of transferring the risk. Okay, and you build legal protections in the agreement so that you can proceed against the absconding dealer legally. So that is a simple part of the credit risk. Now, he supplies Dalmia cement, you wanted ACC cement. So this is again lack of standardization. You have not specifically mentioned in the contract what is the cement you. But whereas if you go to the futures contract, the exchange, everything is standardized. Wheat futures, it will say wheat of so much dryness, so much of humidity, so much of whatever is some specifications about protein content per gram, like that. Sugar of so much specificity, certain things. The rice, everything, the commodity, the features, the specifications are all standardized in the documentation. When you say gold futures, it will say 916 or 100% pure gold. Like that, it will be mentioned. So that is where this lack of standardization were not protected when you did an over-the-counter deal with your cement dealer. Now the cement dealer sends the cement by truck, but there was transit, so all the cement got drenched. Now, this is an operational risk. See, market risk, price risk or credit risk, and operational risk. Operational risk is settlement risk, so you should build transit insurance, something like that. So this is where the risks get unbundled. Now, if the supplier gives you cement, then all the risks remain ununderstood. That is why how the risk is unbundled and transferred, nobody knows. Sab kuch maja hai, like that. If you pay now, 3 mahine ke baad, you will get cement at 200 itself. That is the understanding. So the risks are not unbundled and they are not understood also. So if you had a cement futures contract, if there is a cement future, then you can continue to buy cement from the market at whichever price it is going when you need it, and whether you want ACC, whether you want LNT, whether you want what is that? Please mute yourself. Please mute yourself. Thank you. Now, so you. Please mute yourself. Somebody is speaking on the phone. Gorintha.
Sudha. This is Sudha ma'am. Please move.
Thank you. So, if that contract is available, so 3-month futures, and the price is 206, so you don't pay any price for a forward contract. Similarly, for the future also, you don't pay any premium. So you can buy the future, cement future, at the market price of 200. You don't choose the strike price. In option, you choose the strike price. Here, the market is in the electronic screen, quoting 206 as the price for 3-month forward. You go and buy futures there, 206. Now, the counterparty risk is not there. The price risk is not there. You have already locked it.
Once come here.
Settlement risk. You can buy, you can protect it. Please.
Sir, please ask to mute you.
One second. Yeah. So, yeah. Now, what is that? Yeah, settlement risk, you can build protection through an insurance or things like that. Now, where are we? Yeah. So we move on. So what happens? Counterparty risk here, once you do in the futures exchange, you get the exchange, like CCIL giving you the settlement guarantee fund and the DVP mechanism giving you protection, being the common counterparty to the concept of novation. Here, the exchange gives you guaranteed settlements. So the counterparty risk is eliminated. Whether after 3 months your dealer absconds, nothing, no problem. Here, exchange guarantees you the settlement. Credit risk is taken care of by a margining norms that I will explain a bit later about what is margining norms. Like if you are doing trading in shares, you will know that how you will get a limit, and if the price moves down, how the margin has to be, mark-to-market margin has to be remitted. I'll explain that. But now, price risk here, everybody sees on the screen same 206. It is not that somebody chooses 205 or 207. No choice. It is electronically traded. So market demand, supply, order driven. So everybody gets 206 transparent. And standard settlement practices, that is cement of which grade, what quality, what dryness, what humidity, and lot size is $1,000 per contract, I said, for currency futures, and product specifications. I already, pepper means it is pepper of this much dryness, like that. So everything is specified so that there is no risk. But the spot market goes on as it is. You are buying cement only from your local dealer, but here you are protecting at 206. Now I will show you arithmetically how you will get protected at 206. Wait for a moment. Yeah, it is coming here. Now, assuming on maturity date, the cement price is 150. Whereas you have bought for whatever 1,000 bags means, suppose 1,000 bag is one contract, you have bought at 206. So your price in the futures exchange is 206 for cement. Whereas today, for your concrete work requirements, you bought cement from the market at 150. Okay. So on maturity date, what happens? The futures are always cash settled, futures contract. So you have bought on the exchange at 206, that the exchange will sell or buy it back from you at 150, and they will debit your P&L account with 56 rupees. because 206 is what you bought from the exchange and 150 is the maturity date, what is the price. So the exchange bought it back from you, 56 rupees you lost in your futures contract to the exchange. But simultaneously, you bought cement from the market at 150 and completed your construction. So your effective total cost is 150 plus 56, 200. The other way, if the price had risen to 250, then what happens? Futures, you bought at 206, squared in the futures exchange at 250, your P&L gets credited 44, and you bought cement in the spot market at 250 and completed your construction. So your effective cost becomes minus 250 plus 44, again 206. So you extend this logic to any number, 0 to infinity, it will hold good that your total cost of cement will be 206, net of your futures exchange P&L and your
The squaring in futures cells, that means what?
Squaring means in futures you can physically, academically you can take delivery of cement from the futures exchange itself, but normally all contracts are closed out on the maturity date. If you have bought from futures exchange cement contract at 206, you are long, and then squaring means on maturity date the exchange will buy it back, you will sell it back to the exchange on that day's prevailing spot price, which is 150. So 206 what you bought squared at 150, you lost 56 to the exchange, but you gained in the spot price. What you had assumed to go up has come down to 150, so your total cost becomes 150 plus 56. So either price goes down or comes up. Either way, your price is 206 once you do a futures contract. So this can be there for USD INR, this can be there for interest rates, irrespective of interest rate going to 14 or coming down to 5, you can get the cap at futures at 12%. Means at 12 you are insulated. Like that, this is about the futures contract, the number arithmetic.
Sir, please repeat the same slide, sir, once more.
Yeah. I'll repeat. Now, what was your worry initially? Market price of cement has gone up from 180 to 200. So on the day you require cement for your concrete works, which is 3 months from now, whether prices will continue to rise above 200 to say 240, 250 or something like that. So you said, I have learned in AFM that you can go to the futures exchange and buy cement futures. So in the cement futures exchange price, it was 206 for 3-month maturity. So for December maturity, you bought. You did not choose 206. The exchange was quoting 206. So you bought cement, 1,000 bags. You did not buy cement. You bought cement contract, 1,000 equivalent to 1,000 bags at 206. So that is the first part B. Now in December, the spot price, which is column A, happened to be at 150. So when market is maturing, that futures contract is maturing in December at the price of A at 150. The futures contract, what you bought, is squared by selling back to the futures exchange at the spot price. So 206 plus 150 minus 56 is your futures squaring P&L. Futures means futures exchange. That exchange, like your share trading, what you do on the exchange, futures exchange, so minus 56. And the actual
sir, excuse me, sir. Our contract price was 206, okay, and now the market price is 150. So we are purchasing at lower price. So how come it is minus? It should be plus.
You are purchasing at 150 is what is coming in column E.
Column C. Column C, we are purchasing at 150.
Please listen. 1 second. You are purchasing physical cement from the market, which is the price given in column A, and that action is captured in column E. So 150 rupees, your physical purchase of cement is happening. Now the settlement procedure in the futures exchange is that nobody carries all the cement to the exchange and does a settlement and they carries it back and nothing like that. It is only cash settled and net settled. If you have sold on the futures exchange, you will buy back on maturity date. If you have bought on the futures exchange, you will sell it back to the exchange on the maturity date. That is a squaring process. So the net difference between your buying rate and selling rate, if it is profit, your P&L account with the exchange will be credited. If it is loss, your trading account with the futures exchange will be debited. So that is the process in D, C minus B. There no physical movement of cement is happening. Now have I clarified?
Sir, if the condition is about forward contract, then what will happen in this case?
Sorry, come again.
Sir, if that procedure is of forward contract, then what will be the condition?
Forward contract is the similar, but there you cannot get a fixed maturity, and forward contract is there only for interest rates and exchange rates, not for cement and things like that. So here you don't know whether the cement dealer will shut shop in 3 months or not. So such credit risk and settlement risk you want to avoid. So the physical purchase and consumption of cement, you expose yourself to the normal cash market. Whoever is the dealer who has opened shop on that day, from him you buy at the closing prevailing price of 150 and complete your construction. So A and E is independent of what you do on the derivatives or futures market, which is B, C and D. B, C and D is what is happening in the futures market. First you started at B, 206 bought, and then you squared on maturity date under C, 150. So the net difference is what is done by the P&L of the exchange. They debit your account with 56 rupees. So your total landed cost of cement becomes 150 in the cash market plus 56 debit in P&L, total 206. This is under a scenario when the spot price comes down from your estimate and is at 150 under column A. Yes.
Sir, is it necessary to honor the future contract? Compulsory to honor the future contract?
Yes, compulsory. Only in option you have the legal right to withdraw. Under future, whether you are there or not, whether you are insolvent or so, the futures will debit your account and square off. And for this 56 rupees already the exchange would have collected from you between October and December daily as the price starts falling down. Every day they will collect whatever is the MTM margin. First 206 to 200, they will say 6 rupees mark to mark margin, please deposit. If you don't deposit, they will square the contract on that day itself and debit your account with 6 rupees. That's it. Then it comes to 180. Then they will say bring another 20 rupees. So like this, on the previous day of maturity, already your P&L account 56 rupees mark to market margin you would have deposited with the exchange. That is called the mark to market margin calls.
So for the buyer, if price falls down, then it will be the loss, right? From the future P&L account.
There is no question of buyer, seller, P&L and all, because the objective is to lock into a price. So in the futures exchange alone, if you discuss, yes, if the price falls for the buyer, there is a loss. Correct. But that is compensated by the actual price at which he is buying from the market. It is compared to 206, which was the estimated price. You are buying it at 150, actual cement. So there you are getting it 56 rupees cheaper.
Okay.
Yeah. So your total cost becomes P&L on the futures exchange 56 minus and actual cash given for cement 150, 206. Just the opposite when the price has gone up from in the under column A, it is 250. Second scenario, 250 prices going up, but your cost is remaining at 206 because futures exchange compensates you with 44 rupees that price gain. So this is how you lock into a price. That is what I want you to understand. Okay. Now, somebody asked, what are the characteristics? They are forward contracts traded on an exchange, not OTC, but ETC. Now, supposing you have an interest rate view that will go up. So how you will utilize it? through futures. You don't want to sell your portfolio. SLR portfolio, you cannot sell also. But you know that your SLR portfolio, your prices will fall because interest rates are going to go up. So interest rate futures say you, you sell at 5%. And then if interest rates have gone up to 7%, then what happens? 7 minus 5, 2% is your gain from futures. So whatever price loss has been there on your bond portfolio, part of it you get compensated by this interest rate view, which was correct, and interest rate went up beyond 5% to 7%, and you got compensated from the exchange 2%. Suppose you do it for a notional principal amount of 100 crores and your portfolio is there for what that 100 crores notional principal amount, the 2% difference comes to your account. So 2 crores you get credited. Suppose your bond price loss is only 1 crore 50 lakhs. So the remaining 50 lakhs is your trading profit. So though actually your bond prices have fallen, your total P&L with futures is positive. This is how we combine a futures as well as a bond erosion in portfolio and try to protect our losses. This will partly offset the bond MTM losses. Just an example. Now this is currency futures. Lot sizes 1,000. One lot is $1,000. Suppose you have a $1 million exposure, then you should have 1,000 contracts. $100,000 exposure, you should have 100 contracts. Because each contract is for $1,000. That you should be clear. If the question comes, you should know how to compute the number of contracts that a customer needs to trade in futures to cover his exposure or cover his underlying standard sizes. Now, what is an interest rate swap? We looked at futures, we looked at options, we looked at forwards. Now, swaps. Swaps, exchange, it can be currency, it can be interest rate. Generally, floating and fixed cash flows are exchanged. Periodically, the cash flows, the floating ones will be reset. I'll come to that shortly. Generally, half yearly or annually. And on a notional principle, just earlier slide, I said your SLR portfolio you cannot sell because mandatorily, as long as you are having an NDTL, you have to hold the SLR. But you want to protect the fall in bond prices and attendant rise in mark-to-market depreciation. So suppose your portfolio is for 1,000 crores you are holding. For a notional principle of 1,000 crores, you sell the interest rate future. That is called, the money 1,000 crores will not change hands. Only the interest rate calculation on that notional principle will change hands. I will give an explanation shortly. It will be more clear. So that is why the concept of notional principle. So for this notional principle only, you will pass a contra entry, contingent liability entry in your balance sheet. And in your module D, you will learn for CRAR purposes how this 1,000 crores notional principle will be equated to a certain number of number of asset in your balance sheet through a credit conversion factor. You will learn about that in your module D, credit conversion factors. For exchange traded contracts, so much. For interest rate contracts, so much, 0.5% to 3% and 1% to 10%, depending on the method. The table and all, I think I am covering, or it will come in module D also. 1 second. Now, therefore, the need for credit conversion factors for notional principle that we will analyze shortly. Now, just look at why a swap should be done, and like futures, how you lock yourself when you do a swap. You means as a bank. Now, this is fixed interest rate you pay on your deposit. Assuming you have taken a 3-year FCNR deposit and you pay for 3 years, say whatever is the present contracted rate, say 4% or 5%. Throughout the 3 years, you have to pay fixed on the deposit. So you pay fixed on the deposit. Now, what do you do with that money? You discount a bill. So dollar bill you discount and you receive floating, a LIBOR plus something. Now LIBOR is not there, SFOR, secured overnight financial rate, SOFR. So you get a floating rate, SOFR plus some percentage. So that is a floating. Now this is your problem. Your payment is fixed, while your receiving is floating. So tomorrow, if the benchmark LIBOR equivalent, there is SOFR, comes down, whatever rate at which you will be new discounts and bills you will be discounting will come at lower rates and your NIM will get affected. We looked at this as basis risk earlier in one of the slides. So now here also you have a basis risk problem because FD deposit is on a one rate and one tenor, whereas your bill discounting is happening on a different tenor and a different. Now, if you do a swap to receive fixed and pay floating, what happens? One benchmark against the other. Floating benchmark you are paying, interest rate swap. Floating benchmark you pay and you receive fixed. That market will quote 3% against floating 3-month LIBOR or 6-month LIBOR, like that. So you get that fixed rate from the interest rate swap, and this will be independent. The deposit you have taken from somebody and bill discounted, you have discounted for somebody else. This swap you are doing with a Standard Chartered Bank. So here with Standard Chartered, suppose that deposit was for $1 million. Here also on the same notional principle of $1 million, you will do a deal. So on $1 million, Standard Chartered will give you say 3% and you pay floating that LIBOR plus something, whatever you want to do. So that is how the swap is concluded. So once you conclude a swap, what happens? The paying fixed and receiving fixed on the left-hand side cancel out, and the receiving floating and paying floating on the right-hand side cancel out. So cancel means they even out. Sorry. So what happens? The floating, if it goes up, you also end up receiving higher and paying higher. So you are insulated from a rise in interest rates. Similarly, if it comes down, your payout also becomes floating less, whereas your bill, whichever is getting rolled over or new bills discounted after 3 months, 5 months, will be at a lower rate. So both of them will get compensated or reset on the same floating rate. Now here, both the bill discounting as well as the IRS should be on the same floating benchmark. If it is 3 month SOFR, it must be 3 months. If it is 6 months, it must be 6 months, like that. With that care you should take. But the point I want to stress is, by doing an interest rate swap with Standard Chartered Bank for a notional principal of $1 million, where that $1 million does not change hands, money still is in your balance sheet only, but on a notional principle, you agree to receive fixed 3% for 3 years and pay floating 6-month SOFR to Standard Chartered every 6 months. So next 6 months, if the rate increases from 4% to 8%, you have to pay 8%. But you will continue to receive only 3%. But you are protected. I will show the protection working shortly. Now, suppose the deposit you have taken at 2.5%. So the first column, you pay minus payout from your balance sheet, you pay 2.5% to the depositor. Now, suppose on this day, LIBOR is 1% and bills you are discounting at a markup of 3%. So the bill you will be discounting on the day you pick up the deposit will be 3 plus 1%, 4%. So your net interest margin is 4 minus 2.5, 1.5%. Now your worry is tomorrow if the LIBOR goes down. So then what happens? Your bill rate will come down, your NIM will come down. That is your worry, because asset is floating, whereas for the entire 3 years, you end up paying 2.5% the deposit. So you do a swap with Standard Chartered Bank on the same notional principal amount of the deposit, say one. Normally, if you do it for say 10 million, 100 million like that, but just for understanding, I'm saying. So suppose you receive 2% and pay floating LIBOR. So in the swap, you receive on day 1 2% and LIBOR is 1. So you pay 1% to the swap counterparty. So 2 minus 1 IRS net you get plus 1%. The 1, 2, 3, 4, 5, 6th column IRS net. So 2% fixed, whereas floating LIBOR you paid 1. So 2 minus 1 plus 1 is there. And your bill NIM, which I just explained in the first column, is 1.5. So total after doing the swap, your return is, or NIM is 1.5 plus 1, 2.5. Now, market, we will look at two different scenarios. LIBOR going up to 6%, from 1 to 6. So your bill will continue to be at that same, what is it? Sorry, not bill, your fixed deposit, FCNR deposit will continue to get 2.5%, whereas your bill is discounted at a markup of saying 3% over the new LIBOR of 6. So your bill discounting is 3 plus 6, 9, whereas your FD rate is 2.5. So your net interest margin is 6.5 without the swap. Now in the swap, you will continue to receive from Standard Chartered Bank 2%, and you will pay floating LIBOR 6. So this time, after 6 months, when LIBOR shot up from 1 to 6, your IRS net from +1 became -4. Because if LIBOR went up from 1 to 6%, that 5% increase is what is reflected as +1 to -4. So the net for the bank from both the bill portfolio and the FCNR portfolio, as well as the IRS, is that this 6.5 plus and -4, 2.5. So you are back to 2.5. Similarly, instead of going up, if LIBOR comes down to 0.50, you will continue to discount the bill at 3% plus 0.5, 3.5. So 3.5 minus 2.5, your bill is 1% net. And IRS, you received 2%, you paid 0.5%. So IRS also gave you a net of 1.5%. So total IRS net 1.5 plus bill net 1%, again 2.5. So irrespective of whether the LIBOR floating benchmark coming down to 0.5% or going up to 6%, a combination of IRS and the deposit taking and bill discounting activity, that is the liability asset transformation continuum, which we looked at earlier, that intermediation process, both together, by doing the IRS, you are always protected at 2.5%. So this is another fixation tool. Now, some of the requirements: exposure, counterparty risk. Suppose you did this for Standard Chartered Bank, your risk is not for, say, suppose you did for $1 million. So the $1 million, you don't have an exposure on Standard Chartered. Only the interest rate differential between that 2% and floating LIBOR 1%. This difference is what is your exposure against Standard Chartered on a notional of 1 million. That's all. So don't think that just by doing a deal for 100 crores notional principal, Axis Bank is exposed to, say, Canara Bank if the deal is between these two. It is only on the interest rate bet between the two benchmarks and on the notional principal. So the entire notional principal is not a counterparty risk. That you should be clear. And that is why we convert that notional principal into an equivalent asset on the balance sheet to calculate what is the CRAR, what is the equivalent risk-weighted asset. So only on the cash flows to the exchange for the reset period is the counterparty risk. And replacement cost is the additional risk should the counterparty fail. Suppose this is for a 10-year IRS, and after 3 years, Standard Chartered Bank goes into liquidation. So you have to find out another counterparty with whom you can continue it for 7 years. So that is why the replacement cost is coming as an additional risk. Okay. Now, that is why the concept of credit conversion factor for computing risk-weighted asset. Now, the table for 1% to 10% and 1% to 3% for different maturities, it will be covered in your module D regarding the credit conversion factor. Now, swaps can be currency swaps. So you do buy, sell or sell buy. Both are covered in your module A in detail. In buy, sell, you receive a premium. In sell, buy, you pay a premium. So that concept is not related to this. So it is covered in module A separately. For your arithmetical calculation also, you will need that. Currency swaps. You can have coupon-only swap. That is, you have a Tier 2 bond issued at 8%, and that coupon you can swap against the Japanese yen coupon. But now here RBI has prohibited such things. But academically, you can have a coupon only on the same notional principal of 100 crores. You exchange one rate against the another. But you run an exchange risk there. Those are all the attendant part of it. Then you can have a principal only swap. That is 100 crores versus say equivalent, some $12 million, like that. So like that, you can have a principal only. Then credit conversion factor is always applied on the notional principal, and contingent liability entries are passed. That is why I already told about that. Now, a forward exchange contract we have seen as a simple product, currency forwards. Similarly, for interest rates also, you can have a forward interest rate contract. It is called a FRA, forward rate agreement. So normally you enter into, say, in October, you do a currency forward for December, means for starting from October, and in December it is maturing. So 3 months forward, you are doing a forward exchange contract. Similarly, what will be the interest rate for your, say, floating rate loan that is going to be reset in December? You don't know. Or it is going to be reset next June. You don't know. So if you want to lock into that interest rate, that floating benchmark, which will be deciding the interest rate on your floating rate loan, you can lock into that now itself by buying a forward rate agreement. FRA is a forward contract on interest rates. It is generally, one example I have taken here, a 2/8 FRA means it will commence, that interest rate period is for a 6-month period. 8 minus 2 is 6. So it is for a 6-month period. Half yearly reset loans. But now itself you want to protect your interest rate, the floating interest rate benchmark, that LIBOR, which is going to fall due, or which is going to be the deciding anchor interest rate, say in say December end. So we are in October, so 2 months from now, November, December. December, you want the rate. Now itself, you are locking into that rate, forward rate. So it is 2 months, and then it will run for 6 months. So that is why it is called 2/6. Beginning 2 months from now, ending 8 months from now, it is called a 2/8 FRA. So this you should be able to identify from the numbers given for what period is the FRA, when is it going to commence, and when it is going to end. A 6/9 FRA means it is a 3 months period FRA. 9 minus 6 is 3 months tenor FRA. But it will start, that benchmark will be fixed today itself for a starting of 6 months from now and ending of 6 plus 3, 9 months from now. So that is why this 2 plus 6 is 8, 2 months from now beginning, ending 8 months from now for a period of 6 months. So the 2 is the beginning period and 8 is the ending period. This is how FRAs are named, nomenclature of FRA. That is important. Now a question. A borrower has a foreign currency loan at 6-month LIBOR, which was 1% on first availment. So every 6 months, the loan will be reset. After 4 months, customer holds a view that LIBOR is going up. So his next reset is due after 6 months. That means another 2 months more is there. But in the 4th month itself, he has taken a view that in 2 months' time, it will further go up. So his next repricing is after 2 months, and that should run for another 2 plus 6 months. So it is 2/8 FRA. 2 plus 6 is 8. So he needs a 2/8 FRA, and suppose that price is 1.30. So on start date, that is 2 months from now, if 6-month LIBOR is 2%, the FRA seller, that is the bank, will pay the borrower 2 minus 1.3, 0.70 on the notional. So loan will continue to be with the bank. It will not move hands. But on the same loan amount, notional principal and FRA is bought. And that is why 2 minus 1.3, 1.7. Now, if it goes out also, means if it comes down also, it will be the same. I'll come to that. Now, in IRS, net cash flow is settled at the end of each reset period. So 6 months from now, in the half yearly reset of IRS means it is the first exchange of net interest rate differential happens at the end of 6 months. Whereas in FRA, the net cash flow is settled upfront. 2/8 means 2 months from now, at the beginning period itself, for the next 6 months, what is the difference that will be settled, but discounted at current LIBOR. That means settled not absolute, but because it is settled upfront, your present value concept, you will discount it for 6 months at the present LIBOR. So if the $1 million is the notional principal for FRA, 2 minus 1.3, 0.70. For FRA, 1 million into 0.70, discounted at the LIBOR rate of 1.30 will be settled on day 1. Day 1 means say December. If it is IRS, it will be settled net 0.70 without any discounting at the end of 6 months in June. So IRS settlement happens end of reset period. FRA settlement happens at the beginning of reset period. That is the fixing. Now I just numerically captured a 2/8 FRA. 1% is your loan interest rate. Suppose loan is what is that? LIBOR. Then 1% is the loan. Now if LIBOR moves to 2, your loan goes up to 2%. Now, if you have taken a 2/8 FRA at 1.3, what happens? Market LIBOR is 2, your FRA is 1.3. You get compensated by 70 basis points from the FRA seller. And your loan continues to be at 2, but your effective cost becomes 1.3. 2 minus 0.70, 1.3. The other way, if interest rate were to come down, your loan is also at 0.5. Here, independent of the FRA. This is the original contract. Don't reset every 6 months. Now, FRA again at 1.3. So what happens here? You lose out 80 basis points on the FRA. So total cost again becomes 80 plus 50, 130. So these are all totally you are getting insulated from the downward or upward movement of interest rates when you lock into an interest rate through an FRA. So generally, this is given for 6 months, 9 months like that. Now, all derivative contracts, the documentation is the International Swaps and Derivatives Association Master Agreement, ISDA. They have a 3-stage process of documentation for all. Even for your forward contracts, now you are getting documentation signed from your customers. It is an ISDA Master Agreement. If it is a 100-page agreement, nobody can change anything there. The master agreement is signed at the bottom of each page by a Standard Chartered Bank in London, by a Citibank in New York, or by a KARUR VYSYA Bank in KARUR. No changes, master agreement. Then how can we go and present ourselves in the US court, sir? We don't know the laws there. Suppose the jurisdiction is US. So like this, you will ask questions. All that can be customized in a schedule to the master. Master agreement, nobody touches anything, but they can change anything they want, notwithstanding whatever is contained in the master agreement. The jurisdiction will be the courts of India. If you write there in the schedule, then it becomes India jurisdiction. Instead of 30/360 day count convention, if you want it to be actual by actual, you can change it in the schedule. Like that, so many things. Instead of LIBOR being published by London, you can say FBIL published closing FedI rate or closing USD INR by FBIL. You can change it. Like that, all changes you can bring it into the schedule. And beyond that, after having signed a master agreement and a schedule with each counterparty, each trade will have a separate trade confirmation option. Once you do an IRS, it will have a trade confirmation. Once you do an FRA, it will have a trade confirmation. Another option trade you do, it will have a trade confirmation. So the documentation is complete only if each trade has a master agreement and schedule already signed and executed with the counterparty and followed up by a trade confirmation. Now, in the event of a dispute, the order in which the court will decide of what is to be decided is the preference that is stated in the trade confirmation will rule over what is stated in the schedule, and then what is stated in the schedule will rule over what is stated in the master. So suppose you have put actual by actual in the trade confirmation and 30 by 360 in the schedule, the legally it will be decided as actual by actual, because that is what you have put in the trade confirmation. So for that particular trade, it is actual by actual. So like that, the order in which, yes. Okay, the order in which the legality will be examined will be what is stated in the trade confirmation, precedence over what is in the schedule, and then what is stated in the now. Oh, I don't know that. So this is all about derivatives in brief. We still have some time, so I can even discuss if there are any doubts about all these, whatever we have covered in all the 4 sessions so far. And many of these will be gone into in detail when you come into A module also, especially for those batches whose A module is not over. For them, I am saying. And then your B and D also, there will be crossover, especially yesterday's question. I said about Tier 2 bond payment and a CD payment. And then it was partly from your module D, where the, priority of settlement of a unsecured, unsecured instruments, where the subordinated debt means junior in order to payment or claim of that of a other unsecured creditor. So that is the meaning of subordinate. Like this, in some of the questions, you will find an interplay between module with all the 4 modules. So you should not think of these things in isolation, and you should have a clear understanding and interplay between all the 4 modules together, so that your answer choices are most appropriate. Yes, now it's open for questions. It has been very, extended session for you. Normally we completed 3, that is 3 into 9 hour session, but we have taken another 3 hours extra for you because we started off. Yeah, please.
What is, sir, interest rate collar? You have said
interest rate collar. I said no. If interest rates are going to rise, you have a fear that because your portfolio will lose value, bond portfolio. So you buy a protection beyond 12%. If interest rate goes up, I buy a call option there so that the seller will pay me the difference. So you buy a cap. It's called a cap, interest rate cap. Then you end up paying a premium for that. So in order to recover part of the cost, you also sell a floor. Just like a cap, you sell a floor to another counterparty for interest rate falling below 6% or 7%. So what happens? What you recover part of the premium by selling the floor. And now anything going above, you are protected, and up to a fall up to the floor also you are protected, because your interest is your bond prices will again start rising. Suppose interest rate falls. Now whatever advantage you get in a fall beyond say 7%, goes to 6%, 4%, 5%, that alone you compensate to the buyer of the floor who says to whom you sold it. So there is a combination of a cap and a floor and interest rate call.
Hello, sir.
Bolo.
Sir, what are all the numerical questions we will expect from these sessions, sir? Treasury management.
Already I am posting 1 or 2 every day, and then in the coming days also you can see 1 or 2. Like say, suppose you said you do a futures for suppose you have a $1 million exposure in the market, okay, and you want to cover it in the futures. First question is, how many future contracts will you have to buy? First question. Tell me.
Okay, sir.
Tell me.
100.
1,000.
1,000.
Sir.
One contract is for $1,000. So you have to buy 1,000 contracts. Okay, first question. Now, suppose you buy in the futures dollar at 85. Okay, numerical, note down. dollar at 85. Futures. You have bought in the futures market dollar at 85. Why you have bought? Because you are an importer. You want to remit abroad for an import bill realization. You bought at 85. And on the due date, USD INR was at 86. Futures contract expiry date, USD INR was 86. You made money or you lost money? Second question.
You made money.
Made money.
Make money.
Okay. Because you bought from the exchange at 85 and today you sold it back to the exchange at 86. You made money $1. Great. Oh, 1 rupee. Very sorry. On 1,000 contracts. Okay. Now on $1 million, what is your profit or loss? Absolute. So now you should know how many contracts.
1 million. 1 million.
No, now you tell me in INR. You have bought 1,000 contracts. Let me explain. First answer was 1,000 contracts for covering 1 million. Each contract you get 1 rupee. So what is your 1 million? Okay, $1 million. I agree. Now what is that $1 million? Assuming it is 86, it is 8 crores 60 lakhs. Correct?
Yes, sir.
Okay, sorry, into 1 million is what is that? 8 lakhs 60,000. Sorry, 8 lakhs 60,000. So like this, you have to work out. That will be a numerical question. Then options, it will be given. You have long call, USD INR 82. On the expiry date, market was 83. Long call, I said. Market was 83. So you are in the money or out of the money?
You are in the money.
You are in the money. You can exercise the option and buy it at 82. And what is your profit? 1 rupee. Correct? Suppose for this one option you paid a premium of 20 paise. So what is your net P&L?
0.80.
80 paise. That is a question now. 1 rupee from the options and 20 paise premium you paid. So net P&L is 80 paise. Like this question can come. Okay. And suppose this is given on a particular amount for $10,000, something like that, given which again you have to multiply by another $10,000. So these are the ways numerical questions can come. Good. Then you start working out, especially when I post a question. Those of you who give their reasoning for the answers, they stand to benefit. Some of them may be wrong. So I try to correct them or guide them or counter them. So that the learning process is better for them. Similarly, you also try to reason out. Some of them simply start asking for the answer. The moment I say you are wrong, they'll say answer. Answer is not important. The understanding is more important, at least from a student's perspective, I would say. Good. So if there are no more questions, I would say let me wish all of you the best for scoring 90 plus and start reading your other module papers also very diligently and also work out, keep working out and keep interacting. Don't think that I am too busy and all. I will come back if I am too busy. But rest assured that we will be there to help you out. And the entire next 50 days, if that intensity you are able to increase, you will be able to keep up the tempo. What I wanted to say. For me, it has been a very enriching session, especially the morning in the interactions also. That is where I try to capture your mind. And that is why I keep you engaged. I don't give the answer in the beginning itself. In the evening, I wait. So that I can keep as much candidate as possible engaged in the process. So with these words, let me wish a very exalt, there is a eclat. Eclat means success of a high order, a highly successful BFM result for each one of you on behalf of my team at IBS, that is Biju as well as the other co-host today. Let me wish all of you the very best. Thank you.
Thank you, sir. Thank you so much, sir.
Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Sir. Sir. Hello.
Thank you.
Hello.
Thank you. Thank you.
Hello? Hello?